it will automatically increase your win rate on your trades. It will show valid support and resistance levels. It will show valid entry and exit points. It will help you to determine proper market structure direction, since highs indicate that it's an uptrend, since lows indicate it's a downtrend. My name is Josiah. I've been trading for 9 years since 2016. In this video, I'll properly show you how to mark highs and lows that have enabled my students to achieve better trade results. What are highs? Highs are peak points made by price movements on the chart. And what are lows? Lows are the lowest points made by price on the charts. Let's dive into the charts. So we know that highs and lows can be formed in any trend. If this is a bullish trend, we shall always see price creating highs and lows. And for the bullish trend, we shall be calling them higher highs and higher lows. Higher highs and higher lows. Higher highs and higher lows. Then for the bearish one, we know that we shall be creating lower lows and lower highs. They also tend to create lows and highs as explained. We see price creating lower lows and lower highs, lower lows and lower highs, as we can see in a downward trend. Then when price is creating highs and lows, we tend to have what we call a break of structure. Break of structure happen in continuations. We call them BOS. BOS. As you can see, even in a downward trend, you tend to have BOS. So as I've explained at the start, most traders find it hard to easily mark them. It's a very challenging activity for majority. So we have two structures that I would love to share. So we have structure 1 and we have structure 2. So most traders tend to find themselves calling these highs and lows, highs and lows, highs and lows, and once price is retracing, they get a little bit lost. This is structure 1. The structure looks very smooth. We see price creating a higher high and a higher low. Okay, the same with this. We see this is creating the same structure, but we don't call these levels as highs and lows. Sometimes we call these aggressive point of interest, and I'll explain in the next coming video as you see how to go about the aggressive points and what do they do. If your YouTube is a gem and you want to learn more about advanced trading concepts, consider to hit that like, share and subscribe button, and let's continue. So let's go into something else that I would love to share. So for structure 1, this is how it looks like sometimes in the two charts, and this can be common in all time frames. It doesn't have a specific time frame. Let's call this level structure A, and this is structure B. Now structure A, it indicates that this is a bullish trend, then structure B indicates it's a bearish trend. Now the best way to see highs and lows, we can use line charts. Line charts only read body candle closures, they don't read week readings. So when you put in line chart, this is how it will look like. We shall see price going to this high and creating this low and going high. So where the line chart breaks from is what we call a break of structure. But remember, when put back to candlesticks, candlesticks show wicks altogether. Now me putting here a higher high because on this higher high we have this bullish candle. So this level is the highest point made by price here. If this guy has a long wick, this will become the higher low. If this one has the longest wick, this will become the higher low, as you can see. So this is how you can be able to mark them. So if it's bullish, you put this line. Know that once price closes below with a candlestick, we know that it's no longer a higher low. But once price rejects this level, we know it's now a protected higher low. So we shall see on how to mark them. So this is why I'm showing this chart example. Now when it comes to the bearish one, we see price creating a lower low and a lower high, and we notice that price broke below here, a body closing below all these wicks. So the reason why I'm putting this higher low on this left side is because it's the last lower low being created. So when you put in line chart, this is how it would look like. Price will be dropping to this point, and they will show you that it is stretched to this high and it went to the low if you put in line chart. Now someone will ask, how comes you're not considering this wick? Let's assume we have here long wick on this bullish candle. Why might I consider this? Because when you put in line chart to show you that this is the lower low, not here. The same with this one has a long wick. That's why I put in line chart to show that this is the higher high. That's why this is how it look like together. We can see such a scenario. So we know that once price is able to retrace, we're able to look for the valid entries around the higher low. If it is bullish, then we can go bullish. Okay. Once price comes back to the lower high, we see price be able to retrace up to this side. Then we can be able to push to the downside to break below. So these are why you can be able to mark them properly, high and the low. So we can go into the second structure. Now this is structure 2. So when you put in line chart, this is how it would look like. Price will come up, okay, then come back to the low. Then on this higher low, this point made by price will come and it will look like this: lower low, lower high, lower low, lower high. Then price breaks this major structure. Now most traders always want to buy here. They want to buy here, which is a trap. So if we have here a long wick, this will be my higher low, okay. On this high, if you put in line chart, of course, line chart, it will be like this. So basically this will be my break off structure. As you can see, this will be my higher high and this will be my higher low altogether. If this one has a longer wick, this will become my higher low altogether. And this is the only levels we shall be able to look for entries regardless of whatever concept you trade: smart money, ICT, supply and demand. This is how you can easily support your levels. So you expect price to be able to retrace back down. Of course, it will come back in what we call indirect retracement, whereby price comes, respect these levels, go high, come back to these levels, go high, then comes to these levels, then goes high. If factors favor of confirmations there, we shall see in future on how to go with confirmations and also risk entries. Or price will come in form of direct retracement. Price will just come back down to this level and you'll be able to buy from there if it aligns with the higher time frames, okay. So this is how you can easily mark them with ease together. You just have to look at the lowest point, because a low, you have to look at the lowest point made by price, and on that lowest point you shall always see the longest wicks here. We can always use the line chart to guide us to easily spot the key levels, okay, where you can know that price broke structure here, and the line chart will show us that this is the highest point made by price, what we call the high, and it will show us the lowest point, what we call the low, as the lowest point made by price here, which will become our low. So most traders tend to mark them in a wrong way, okay. You need to train your eyes to see them clearly. Are we together? This is structure 2. And for structure 2, for the bearishness, it is the same situation. Price was able to come and create a lower low. As we see that if you put in line chart, will show you that price came back to this low, then went to this high to create the lower high. So line chart will show that this is the way it stopped, not on this bullish one, as you can see. Because you need to use line chart, then by time you can be able to use your eyes to easily support that levels, okay. So when price retraces in line chart, you show you that it stopped here, then it went to this bullish one, then went to the bearish one, okay, then it went to the bullish one, because the line chart will read the closures, then price will come to the low and break structure here, okay. But remember, the good break of structure, we need to see a wick to body break. So price will be able to retrace to the upside in what we call indirect retracement. Indirect retracement, price comes back to that level, respects this level, then pushes up to this new level like that, okay, then goes up, comes back maybe to the highest point and sells, okay. Regardless of whatever concepts you trade, make sure you be able to use either confirmation or risk approach, of which we shall do the next video. Always keep on liking and sharing. We shall be able to drop in the gems. So at this point, as you can see, we shall always put on this highest point where you see where the curve stopped on the line chart. So we shall always mark this as a lower high. And this lower low, where you see this point stopped in line chart, you mark this level as a lower low. So or we can have what called direct retracement. Price will just come direct to that level and sell together, regardless of the direction you're in. So this is what I want to show people, to mark the valid lows and highs. Valid lows and highs. Those are one of the common structures that are formed by price that I can pinpoint. So we can be able to go into some chart examples. So as we can see, I've opened up a chart for gold. I've just picked up any asset. This works in all assets, not only gold, okay. So as we can see, it's very hard for someone to easily understand which one's the high and the low. Some people tend to zoom out the chart and they take this as a high, then the low, like that. Then they find themselves calling this a high. But when they have missed so many opportunities here. So to simplify it, as I told you, we shall always use line chart together with candlesticks, such that when it reaches time, you can be able to spot these with your eyes. So as you can see, I'm going to show you something. I can just pull out my tool, higher high, higher low, 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 higher high. So remember that the higher the time frame, the clearer the structure. The smaller the time frame, we shall find there are a lot of key levels, and this is why traders tend to make more mistakes if they go to smaller time frames. So if you observe clearly here, I'm marking this as a higher high. See, I'm putting on this wick. On that wick, this is the higher high being formed here on this blue candle, because I mark blues to be bullish. Then you see this one has the wick, but I'm going to put on this lowest wick, as you can see here. So if you put here in line chart, you can notice that that even though I pull out my tool and I put it here, we can see once price taps in this level, it's the highest point. So remember, as I told you, line chart doesn't show wicks, it only shows body closures. Okay, so as you can see, when I put back to candlesticks, these wicks, this becomes my higher low, this becomes my higher high. So you can even see this even here, this level, you see where there's a bearish candle, then you also have this high, you see that. So I'm going to be able to put it here, okay, not on this bearish one like this. No, I want to put it on this bullish one, the close one. You see, these are 1, 2, 3 candles. So people used to supply and demand, they used to call this rally based rally, and those who do smart money, they tend to call these as zones, or what we call order blocks. Are we together? So as you can see, this is what we notice, but this is what we call the higher highs and the higher lows. So they give you that impression. So when I put back to line chart, you see where we see a strong bend. This indicates this is the highest point made by price. So we shall have here a candle and a wick. So even see this V shape down here, this indicates we have here a higher low. As you can see, this is gold, I'm just showing you that. So even here you see this candle, this bearish candle has the longest wick. I didn't put on this one, I didn't put on this one, I put on this one. Okay, and I also put on this high. Are you together? Such that if price had come back to this level, I would be able to say, okay, maybe buy at this level down, or to that key levels. Okay, you can see here the same thing. So if I put in line chart, it's the same thing. You see that? So when I put back to candlesticks, you can see the same here. This is the low. I'm not putting on these candles, okay, because when I put in line chart, it will show that this is the lowest point. You see how it's matching with my crosshair that I'm seeing on the line. The same here on this crosshair. When I pull up, it's the same structure being shown. Okay, here. If you put just on the line chart like this, it will be disturbing. So you can do this, then you pull back to this blue candle. This is the high that was formed here. Okay, so price forms this low. I know some people do a mistake and they put here, but if you observe, this will be the best level to look at. Okay, the same here if you observe this level and this level. So you can see when the bodies are closing above these wicks, indicating this is a wick to body breakout structure. So if I put in line chart, we can notice that this one I marked is a little bit wrong. So somewhere here we had the breakout structure. You see this wick here, this is the high, this is the low. Are we together? The body closing above the wicks is what we call the breakout structure. So if we go to small time frames like H4, we notice that price has been also creating series of higher highs, higher lows. So you can easily see that even in smaller time frames, it's the same concept. But if you go to smaller time frames, you start seeing out of structure too. As you can see, we have these inside structures. So people tend to get lost. They say this low, yes, broke structure, but in reality, this is the origins. Okay, as you can see that price created a higher high, higher low. So traders have a tendency to believe that this low that broke structure is the true low, but in reality it's not, because price will always go back to the origin. This is the lowest point made by price. This becomes the higher low. Okay, so expect price to come back here in the long run, but it's not always the case that it always come back here. But for higher chances to increase precision and more win rates, it's much better to wait for price to come back here after taking out those levels. Of course, also have tendencies whereby it can decide to stop here and continue, or sometimes it can also stop here and continue. But for more better scenarios, much better for price to stop here and we continue high. Okay, for the time I've been trading, I've been noticing such scenarios. So you can even see here we also had the same structure. You can see that price created here a low, lower low, lower high, low. So most traders would want to sell on this, but this was a trap. Price goes higher, takes them out, then goes to the downside before shooting. Okay, so basically we had here a selling structure together. This was the lower low, this was the lower high. So someone wanted to sell here will be taken out. So this is what happened. Price comes, takes them out, and comes back to that high. So basically it was like creating a structure too. So your role is to always avoid to call this as a true lower high. This is the lower low and this is the lower high. So price comes back to this level to continue to the downside. Okay, so we can always notice such scenarios. So always avoid these levels. So we can see that price continues to take out this high, highest point made by price, lowest point made by price. This is the higher high, this is the lower low. This is the higher high, this is the lower low, this is the higher high, this is the lower low, this is the higher high, this is the lower low. Because I can easily see them, you just have to switch to line chart. You notice that we have here a body closing above these highs, wick to body break. You can notice that this is not a good level. We expect this to be the low. Okay, the high the low. Now here you have the high, the low. Make sure you get a body closing above the wicks to call it a valid high. Are we together? So those are the examples I can be able to show you. All I can be able to give you as a warning is that make sure before you mark your highs and lows, you've done top-down analysis, you've got a very good strategy. You decide either to take your time to be able to fast mark the highs and lows perfectly to increase your precision. Is it okay? What I'm giving is not an investment advice that you can just go and mark and trade that, but add in extra